Good afternoon, everybody. My name is Jamie Terrell. I lead marketing and communications here at Saltmarsh. We're happy to have you here with us today for part 5 of what seems like it might be a never-ending PPP series. That's okay though. We're in this for the long haul. So we're happy to help you guys navigate the many financial impacts of COVID-19, including the subject that we're here to talk about today, the Paycheck Protection Program. If you are a regular guest of our weekly webinars, welcome back. If you are here with us for the first time, we'd also like to welcome you and thank you for spending the next hour with us. Here again are 3 members of our COVID recovery and response team, Suzanne Cox, Glenn Scharf, and Andrew Kent, all shareholders here at Saltmarsh. We're glad to have them leading our presentation today. Before we begin, I have just a few housekeeping notes to mention. First, everyone on the line has been muted. If you do have questions during the presentation, feel free to share them with us in the chat. We should have a few minutes toward the end for Q&A, so we'll address some of your questions together. You're also welcome to share your questions with us by email to ppp@saltmarshcpa.com. That email is also in the chat box for you to reference. If you email us there, someone from the team will follow up with you directly. Today's presentation is being recorded and you'll receive it tomorrow by email along with a copy of our slide deck and presentation resources. In the event that you don't receive that email, we've had some people with some trouble receiving our emails. You can always visit our COVID hub, which you see here on the screen. All of our webinar materials are posted the following day, so you can find them there if that email doesn't make it to you. But in that email, you should also see a link to complete a survey. If you'll take just a minute to share your feedback with us. We would love to hear what you think of these virtual events. We can hopefully continue to hold them for you. With that, I will pass the mic over to Suzanne Cox, shareholder in our audit and assurance practice, to get us started. Suzanne.
Hi, everybody. As you can see, Glenn has some new surroundings today. His power went out, so he's risking his life right now at the office to host this webinar for you guys. And Jamie has also moved locations as well, but I think she just disappeared. But so we're all still hanging in there. Hopefully you guys are as well. So you're probably wondering, why are we still here? So a few things. We really love PPP and we love spending our weekends reading IFRs. So, we had nothing really better to do than give you guys another webinar with some more information. So here we are. Realistically, though, the PPP application deadline is not until 8/8. So if you haven't gotten a PPP loan, you still have that opportunity. So there are still questions out there. We're still getting a lot of questions. And as Jamie mentioned, we have a whole team that's actually filling out or reviewing applications for our clients and our non-clients. And so they're busy. We've still got things to talk about. So the other item to note here is that most banks are not accepting applications yet. And we're going to talk about maybe why a little bit later. But so that's why we're here and a little bit of our agenda for today. So why are you still here? So you really wanted to see us. I know that's probably your main reason, but the reason is that you probably still have some more questions. And so you're hoping that we'll give you some nugget of wisdom today, and we hope that we will do that for you. So many of you have not filed your application yet. Most of our clients and people that we've talked to have not filed. So they're in the process, they're uploading documents to us and they're getting things ready, but so far nothing's been filed. So we know you're excited to be here, and I am going to pass it over to Glenn now.
All right, thanks, Suzanne. And so as a little bit of a change up, we're kind of trying to keep things fresh. We have come up with our top 10 list of all things PPP related and what you might want to know, questions that we've been asked. So different things that, trying to keep these webinars as up to date as possible without boring you into minute details of accounting calculations and things like that. So with my Gator background mascot, we're going to go into the top 10 list. And number 1 is 8 or 24 weeks. When can I file? So this is a big question. When can you file and when should you file? Potentially two different answers to those 2 different questions. So depending on when you got your loan, if you got your loan prior to June 5th, you can certainly choose between an 8-week covered period or a full 24-week period. So, from the date the loan was funded. If you've gotten your funding after June 5th, which in all honesty, most people have not, but you still have only the 24-week period. However, there's a limit to where you go, and that's to December 31st. So if you're getting your PPP funds now, or if you're going to apply before the August 8th deadline, your covered period is going to end December 31st. So when can you file? You can file as soon as your money runs out, which was a big question that was answered. And on the next slide, I think we've got some documentation on that. Yeah, so the truth in labeling. With the extension of the cover period came a new question. Which period do I choose and when can I file? So the which period you choose is kind of really based on facts and circumstances. The facts and circumstances may dictate a 24-week period, especially if you're having trouble spending all your funds within that 8-week period. So in order to get full forgiveness, you may have to go out into the 24-week period. But as this interim final rule states that, a borrower may submit loan forgiveness application anytime on or before the maturity date of the loan. So including before the end of the covered period. So we believe that, if you're in week 12 right now, that you are able to file for forgiveness. Now, here's the other problem is, and we'll talk about this a little bit later, is, why can't we file? The banks aren't accepting them, things like that. And so when does that time period end as far as when you submit your documentation? So really, looking at that maturity date of the loan, or the date that you run out of money. And you want to make sure that you've actually truly run out of money by applying all of these things, making sure that you don't have an FTE problem, making sure you don't have a salary reduction problem. So there are different situations where you may want to wait longer, so you can have more funds in the pot, more payroll covered expenses in the pot. So yeah, this is the factors to consider. So the eligible expenses don't run out when your PPP loan proceeds run out. And so, that's one of the things that we've recognized in the forgiveness process and the application is that, you can have expenses your entire covered period, so your entire 24-week period. Even though they may not be paid from the PPP loan proceeds, they are, covered expenses. So you kind of have to look at that. You have to look at, like I said before, your reduction in salaries, hourly wages, FTEs. If you've spent all your money in the first 8 weeks, you had no hourly wages reductions, you have the same employees, then go ahead and file in the 8 weeks and you can be done with it. If you foresee future reductions in salaries, hourly wages, changes in your full-time employees and things like that, you may have to be more strategic about when you file for the loan forgiveness. And then finally, are you going to get forgiveness before year end? And that kind of really depends. Once again, we've reiterated that the lenders have 60 days to review and submit to the SBA, and then the SBA has 90 days to approve. So I think, we're coming up on that date very soon of, essentially 5 months, which would be the end of July. Yeah, so if you don't file for forgiveness by the end of July, it could be pushed out into next year. But as we know, and as I think we mentioned later on, that most banks aren't even accepting applications yet. So most likely it could fall into next year.
You guys will have to excuse Glenn. He just finished the 7/15 deadline, so he doesn't really know what month it is right now.
Right, I have no idea.
It's one of those years, where we're like, what day is it? Another thing to note here is that there is rumor, you guys have probably heard about it, that there may be an affidavit for those with loans under 150. So if your loan is less than $150,000, you may be allowed to get away with signing an affidavit. So that is not, just hear me now, that is not passed yet, that is not definite yet, but we have heard rumors. So that would be a reason to wait. If you're less than 150, I would sure wait and sign an affidavit versus going through the entire forgiveness application process. So Andrew, we're going to walk through some examples with you and our good friend.
Excellent. Well, good afternoon, everybody. Thanks for taking a few minutes to join us today. And despite our promise not to bore you too much with calculations, we're going to bore you with some calculations for a couple minutes. So really, to the point that Glenn and that we've been talking about here, how do you make this decision? We thought it would be helpful just to walk through a couple of quick examples, because it does, each of these calculations, each borrower's decision is going to have to be based on what their circumstances are. So you may recall, going way back to May and PPP webinar number 2, I think it was, we introduced you to a little hypothetical here, our friend Dudley Do-Right. And these numbers are coming straight from that webinar, so you may remember some of them. But Dudley had a $250,000 PPP loan. He didn't have any FTE or wage reductions. And he had $190,930 in forgivable expenses.
Don't forget that 95 cents.
And the 95 cents were counted. That's right. Thank you, Suzanne. And so if Dudley were to have selected the 8-week period, that would have left him with $59,069.05 to be repaid. And so, this is a clear example where this is what the Payroll Protection Program Flexibility Act was designed to fix. Under the original 8-week covered period, lots of borrowers were finding themselves in a situation where they weren't going to be able to achieve full forgiveness with their funds. They essentially had 2.5 times their average monthly payroll, and they had to spend it over 2 months. Many borrowers didn't have enough other ancillary expenses that would offset that, that remaining half a month's worth of payroll. And so in this example, Dudley wasn't quite achieving full forgiveness. So then let's go to the next slide. So we've talked about this a little bit in the past, but we thought we'd break it down and kind of show it in the form of the current applications that have been released. But here, so let's step back and let's take Dudley's competitor. Dudley's competitor, Snidely Whiplash, his arch nemesis in business and in tying damsels to railroad tracks, apparently. Y'all remember your Rocky and Bullwinkle. Has a similar business to Dudley. You got the same 200.
Showing your age, Andrew.
I know, I easily show my. They were in reruns when I was a kid, but still, has the same $250,000 loan as Dudley. If he waits out the entire 24 weeks, what you see here is that Snidely can easily obtain full forgiveness, because if he continues out for in full 24 weeks, his total payroll costs are going to be over $500,000. His business interest, business rent and lease, utility expenses, these don't go up dramatically. But at the end of the day, his sum of lines 1 through 4, 566, the PPP loan amounts to $50. That line 7 there is a test that the program looks at to make sure you're spending at least 60% of your loan proceeds on payroll costs. And basically, you take the lesser of lines 5, 6, or 7. And so the lesser of line 5, 6, or 7 here is $250,000. Snidely, by electing the 24-week period, gets full forgiveness. So then the question becomes, can Snidely file earlier than the end of 24 weeks? And Suzanne, that's the next slide. And so this is where it goes back to the IFR that Glenn was referring to earlier. So Snidely doesn't have to wait out the entire 24-week period. The guidance that we've received says that borrowers can file early. And so if you just, using our little hypothetical that we worked out, if Snidely just waits out to week 12, so just an additional month over what he was originally allocated, his payroll costs would run out to about $288,000. He's got some business interest and rent, lease expense, and utilities. And that the sum of those four numbers is $294,219.31. And his loan is $250. The 60% payroll test means that it had to be at least $480,000. So clearly here, Stiley can file early, still take advantage of complete forgiveness, and doesn't have to wait out the entire 24-week period. So this is an example of how that flexibility now, and this is essentially what we're advising clients to take a look at. You need to be tracking this either on your own or through the help of your CPA or an advisor. Track this and kind of understand where you are. And once you're in a position where you're comfortable that you've reached the number you need to be at to achieve full forgiveness, then we would recommend going ahead and filing, because all those clocks that Glenn went over earlier, the 60-day clock that your lender has, the 90-day clock that the SBA has, you can start that process in motion. Glenn and Suzanne, anything y'all want to add before we go to the next slide?
Yeah, I think just one thing, our team that's working on these, this is what they've been really busy doing right now, is helping make decisions on, hey, have we reached the right amount? Should we keep waiting? So if you have any questions with that, we'd be glad to help you. Otherwise, you could put together a schedule similar to this in Excel and figure out, where your point is that you would be good to file. I know I'm going to back up one slide real quick. This was a question that we had very early on here. Can the amount of the expenses exceed the amount of the PPP loan amount? So just to clarify what Glenn said earlier, is that you can have eligible expenses and you can spend more on eligible expenses than your actual loan amount. And so just wanted to reiterate that that can be higher, and given the longer you wait, the higher those expenses will be, and they will minimize maybe some reductions you may see for FTEs or salaries. So, and I think we're going to talk about that a little bit more, Andrew, here.
Yeah, and Suzanne, just to add to that, I know you and Glenn and I, we've all seen, we've had clients who had filed early, were had the option of choosing the 8-week period, and we're thinking, man, I just want to get this over with. I'll take $30 or $40 or $50,000 that I'm not going to get forgiveness on because I want to file now. I don't want to be in this thing for another 2 or 3 months. But with the flexibility to file early, and combined with the fact that most lenders aren't even accepting applications for forgiveness at this time, there's really almost no reason to select the 24-week period, ensure that you've got expenses that exceed the, that are such where you'll get full forgiveness, and then file as soon as you get
So all of you type A people, just simmer down, wait a little bit, and most likely you will get full forgiveness.
So there are, as this slide shows, and this is our last of our accounting slides, I promise, but this slide kind of goes.
It, Andrew.
What's
That's
that?
what we're here for.
Yeah. This slide kind of shows some of the other benefits, however, of the extended period. So, we have a number of clients who, if maybe for whatever reason, they're not eligible for one of the safe harbors. So they're in the full application, the long form application. And maybe they've got some concerns because they made some salary reductions, or they had some FTE reductions. They had to let some people go. They don't have the same number of people working, and they're concerned about those mechanisms. And for those of you, if you don't remember, inside the forgiveness process, there are a couple of mechanisms that reduce the amount you're eligible for forgiveness for. One is called a salary and hourly wage reduction test, and the other is called the full-time equivalency reduction test. And so what the extended period means is that even if you have to cut back on payroll, even if you have to cut back on people, there's still the possibility you can achieve full forgiveness. Whereas back in the 8-week period, it was just virtually impossible. So let's go back to Snidely, since we're on him today. And let's assume that Snidely can't use the forgiveness, the easy application, because he did cut some people's pay. And he did reduce FTEs by 25%. Normally, for example, that FTE would reduce the amount you're available for forgiveness for by a full 25%. That could be a huge hit for a lot of borrowers. But with the ability to wait out the entire 24-week period, Now, you'll notice that now our payroll is at, for 24 weeks is only 427 compared to 566, or the sum of lines 1 through 4 is now only 427 compared to 566 because he did have those FTE reductions, but still, because he's able to run it out over the entire 24-week period, even with a $25,000 salary and wage reduction, even with a 25% reduction from your FTE quotient, he still ends up, Snively still ends up with $301,876.55 for his modified total. That still exceeds his PPP loan amount, and he can still achieve full forgiveness. So this is one of the real benefits of the Payroll Protection Program Flexibility Act and the ability to run your covered period out and select when to file.
Hey, I've got two related questions here that have just popped up in the chat that kind of relates to this. We've got one that says if we select the 24-week option, reach our costs in week 10, do we file for forgiveness with the FTE and wage reduction calculations be made at the date of the 10 weeks? And that the answer to that is yes, right, Andrew?
That's right.
And so, and then the other one is so the 8-week period and the 24-week periods are not hard periods of time. If we use all the PPP funds at any time between those periods, we should file for forgiveness. Is the 8-week period a mandatory time frame, or is that, can you file for forgiveness after 6 weeks?
I think, well, I mean, at this point, virtually anybody that qualified for that is well past 6 weeks.
True.
You're probably well past your 8 weeks at this point. So it's probably a moot point for most, but the guidance allows that you can file at any time prior to the end of your covered period. And so, yeah, I think these questions are directly on point and go directly to the heart of kind of some of the decisions that that borrowers are looking at and trying to make right now.
And I did want to note, we had one question came through about where does line 7 come from? That is actually one of our top 10 questions, is how and where does that FTE reduction quotient come from? So we will get to that. Anything else on this one, Andrew?
No, I don't have anything else right now. I think that's, these are we're just trying to highlight here some of the decision-making process that the Flexibility Act has introduced into the borrower's decisions here.
Yeah, and we understand this is complicated, and there's a lot of, .95 cents up in here. So if you guys have any questions, of course, feel free to email our PPP, and we'd be glad to walk you through some of these. We understand it's
yeah, and once you file, I mean, these FTE calculations, I mean, they go away once you file. I mean, so if there's a future reduction in staff that's needed or something like that, we don't believe that it's come back and monitored after the date that you file.
Yeah, and just Suzanne, just since you did have a question about where does line 7 come from, to be more direct, if you are stuck in the long form application, which we think most people should not be stuck in that, but if you do find yourself having to file using the long form, that FTE reduction quotient, there is a calculation that's contained in Schedule A that feeds that. So you have to go through a process where you analyze all your employees' hours, your number of FTEs by employee, and you calculate out a quotient. We're not going to go into the mechanics of that calculation today. We've touched on it in some prior webinars, but essentially that number is coming through a series of calculations that come from the Schedule A, the forgiveness out.
4 webinars to be exact. So
yes.
In case there is something that you need more information on, we have webinars 1 through 4. Apparently we are all on YouTube now. So if you guys have some downtime and really want to watch some more P3 news, jump on our YouTube channel and check us out. We do have some very detailed calcs, and again, email us. We'd be glad to send you the slides or a direct link. So keep
Suzanne, back over to you.
All right. So question number 2, we realized question number 1 took about 20 minutes. We promise that the rest of the questions will not take 20 minutes. We will get through these 10 questions today. That was the big beefy one, and these are a little easier. So still questions, we're getting a lot though. Can I give out bonuses? Absolutely. The one thing to note here though is what we just talked about is the time frame has been extended, and so initially there was a lot of concern over I'm under my amount, I'm under I'm not going to get my full forgiveness. So can I, shove out some mid-year bonuses in order to meet that forgiveness level? And that is completely acceptable. You can do that. It just needs to be included in the employee's W-2 wages. But at this point, with that lengthening of the time, it may not be necessary. You may, and I mean, there's really no reason why you couldn't wait out the full 24 weeks and get forgiveness without giving a bonus. So yes, you can, it's absolutely okay, but you may not need to. And I know a lot of companies, at least my clients, are calling me, and the discussion has shifted a bit to, what's the next half of the year going to look like, and my cash flow is starting to get pinched, and that may not be a decision that you can make right now to give out bonuses. So if you're in that position, great, but consider your cash flow needs out about a year before you make that decision.
Suzanne, just another couple quick comments there. Two other things to consider. You do have to make sure that you're not comping anybody at a rate that exceeds $100,000 a year. So that's right. Continue to be a limitation. And I think your point about strategically, back when our clients were looking at an 8-week window before the Payroll Protection Program Flexibility Act, bonuses were definitely something that people were having to consider or even making. At this stage, it's certainly a lot less necessary. And, we've already started to have some conversation with clients that wanted to and did pay some hazard pay bonuses early on, but are now finding that, as this COVID event drags on, and as Suzanne, as you say, as their PPP money runs out and other decisions, they're finding that they're having to walk those bonuses back, and that can be a challenging environment for your employees as well. So that's just another something to consider if you're asking the bonus question. So.
Yeah, and we strongly recommend communicating with your employees as well. So if they normally get a year-end bonus and maybe you gave one out earlier in the year, just communicate that maybe the year-end one may not happen, due to obviously what's going on in the market. So have that conversation. So here, back to our FTEs, what exactly is an FTE? And so that means an employee that has worked more than 40 hours on average each week. So you can't have a full-time employee that works 65 hours that gets 1.25 or something. That's not how that works. So 40 or more is one FTE. That you can calculate it 2 different ways. So, there's a simplified way that if they work less than 40, they're a half. If they work more than 40, they're 1. And then there's the prorata that you would need to do a calculation for. So the one thing to note here is that Andrew mentioned it earlier, is that if you do get stuck with the long form, you will need to calculate your FTEs by employee. So, have a spreadsheet with each employee, and you're listing out their hours, and you're trying to figure out exactly how many you have.
Suzanne, I'll just one other quick comment here. I know we had a lot of clients that were, that were very concerned about this early on. We have a lot of clients in the skilled nursing area, for example, who, the fact that FTEs cannot exceed more than 1.0 FTE per person was really hurting them, because they were having employees go out on COVID quarantine. They were having to ask people to work double or triple shifts, and they were having people work 60, 65 hours a week, but they were only getting credit for 1 FTE. Some of the safe harbors that were introduced in the Payroll Protection Program Flexibility Act have eliminated some of the concern over these calculations, because if you're in an industry that's been affected by the virus or had to make operational changes or lost business, you might have a safe harbor where you don't even have to go through this, but still it is something that was impacting a lot of people. Anyway.
I could not find an emoji with a pink slip, so I had to go for the boring hand here. But what if employees quit or I fired them? We're getting this one a lot, because obviously times are tough right now and people have had to make layoffs or furlough employees. And so what does that mean? Does your FTE count get penalized for that? So there is a very important piece of this entire bill and process, is there are exemptions for rejected offers to rehire, for people that were underperforming, you had to let go for other reasons, people that just left, they said, I'm not comfortable coming to work under these circumstances, and I'm not going to work right now, and you've tried to rehire, or you've tried to hire new people, and it's been declined. So there's a certification that you will be able to take or sign for that says that your business was not able to operate between this period of time at the same level of operations as pre-COVID. And so at this time, we think that most borrowers will be taking advantage of this certification. There are very, few businesses that we're working with right now that can't, justifiably make that certification. Either they haven't been, open as much, or they've had to close, or they've, again, had to downsize. So that is, giving your business the ability to certify, hey, I have not been able to run at the same pace as I was before. Now, there's some questions here that we, can't answer. We don't know. As far as we know, you're just making a certification. We don't know if they're going to ask you for P&L statements or anything like that. We don't know. Right now, all we know is the certification exists. And so if your loan size over 2 million, we aren't exactly sure how that will be audited. So we have read and are advising all of our clients to keep everything. If you have made offers to rehire, keep the emails. If they've declined offers, you need to keep your notification to unemployment that person is unemployed. And keep emails. HR files need to be very robust in this period. So you HR managers are going to be busy, because this will be important if you get audited, to be able to prove that these employees decided not to come back, or you've made offers. So anything to add there?
Yeah, I think you covered it.
This is the $1 million question, number 5. Why is my bank not accepting applications? So we don't really know. We're not the banks. Just kidding. But right now, the SBA is not accepting applications from lenders. So we heard rumor that may happen in mid-August. We don't know that right now. So this, our answer here is completely speculation, although we have a very large base of financial institutions as clients. And so they're kind of telling us what they're doing. But, we had a few questions come in that said, have you taken a bank survey? Do you know when they're going to start? What is their pulse right now on this? And no, we haven't, and we don't know what every bank is doing. So you've heard us on our previous webinars, and we will continue to strongly suggest that you talk to your bank specifically and ask them, hey, when do you think my portal will open, or when will you start taking applications? Some banks are denying written, paper. Some people are just saying, I'm going to certify mail mine. That bank may not take that. So you need to make sure what your bank is doing. And if they don't have a portal, or they haven't communicated with you, reach out to them. They're very overwhelmed right now. So, also be patient with them. This is a lot of work. So keep that in mind when you're asking them what's going on, because they're very overwhelmed right now. So anyway, they don't want that 60-day to start ticking. So you see in number 2 here, the lender has 60 days to review and determine forgiveness. So if you submit your application today, their clock starts to run. And so if the SBA says it's mid-August, but then they decide, we're really not ready yet, which would not surprise any of us, that 60-day clock is still running though, and now SBA won't take the application, and the bank's sitting on it, and it's going to be a big cluster. So that's our speculation again on why banks aren't accepting them. But again, talk to your bank specifically. Anything else there?
No, I think you got it.
All right, well, I'm going to move this over to Glenn to talk about comp.
Oh boy, comp. The big question, the elephant in the room, right, is what can we do? In fact, I've been monitoring the chat. We already had a question about this, in the caps on compensation. So non-owners. So first of all, it depends on which time period, which covered period you're choosing, 8 weeks or 24 weeks. Remember that, your loan is based off essentially 2.5 months of your average monthly payroll for last year. So the original 8 weeks, had the $15,385 as a maximum. So going into the 24 weeks now, we've expanded that to 46,000. So it's still, the $100,000 limit on any non-owner in any employee, There's still a $100,000 limit, but it's a matter of, do you take it over 8 weeks or do you take it over 24 weeks? And so that's the big difference. For S corps, partnerships, self-employeds, the owners, either 8 or 24 week, your numbers are a little bit different. So the 8-week maximum is still 15,385. That's if you were over 100,000 in the prior year, or it's 8/52 of your 2019 payroll if you were under $100,000 last year. So, and then the 24-week period is even is very restrictive in the sense that it takes 2.5 months of your 2019 payroll, or 20,833. So basically, the 20,833 is actually that would be your loan if you were the only person with payroll and you had $100,000 average monthly payroll. That would be your number of 20,833. So, but once again, you're restricted to that 2.5 months out of 12 on the 2019 payroll. So if you have dreams of reducing people's salaries and increasing your owner salaries, that's not going to fly. You're still restricted by these amounts. That was the whole point of the restrictions in the first place, was so that the owners would not be increasingly benefiting from this program. So
even though the news would like to tell you that's what's happening, it's not.
What's that?
I said, even though the news tells you that's what's happening, it's not. There is a cap. Yeah,
there is a cap.
And Glenn, just Suzanne, back on that slide for just a second. Sure. Just one thing, because I know I've got, and I think we've all got some questions on this. Oops. Jumping forward. Yep.
I went too far. Sorry.
Just, as Glenn described, that 8 weeks was literally 8 divided by 52 times, 100,000. 24 divided by 52 times 100,000 gets you to 46,154. Though the guidance is a little unclear here, we think what it means is if you file early, your cap is going to be based on whatever, however many weeks through the date of your forgiveness application divided by 52 times 100. That's going to be your cap for any non-owner employee. Essentially, just think about it like this. You can't pay somebody at a rate that would exceed $100,000 a year. For whatever period that you're capturing costs for, you can't pay anybody at a rate that exceeds $100,000 a year. I just wanted to point that out.
Good point. All right, Glenn.
Yeah, so number 7, 60/40, what does that mean? If I hit 100% with payroll, can I ignore everything else? And the answer is, yeah, you could, for sure. Getting back to that calculation that Andrew had up before, you've got that, one line that asks you, to divide line 1 by 60%. And so if that number is less than, your loan amount, then that's where you're going to be limited. Obviously before it was 75%, and now we're 60%. Once again, I don't think that unless you are completely closed for the entire 24-week period or a majority of the 24-week period, people aren't going to have a problem with this 60/40 because, once again, even if you run out of money, you can still, kind of keep the expenses that you're paying as eligible expenses. And so, and the other thing is that, utilities, interest, rent, I mean, we have very few clients that have been greater than 40%. Certainly utilities, unless you're a manufacturer and have, some high utility bills, that could come into play. Rent, certainly if you're, leasing automobiles for, a fleet or something like that, that could come into play. But once again, I mean, it's 60% of the loan value. So if you stretch it out to the 24, week period, absolutely, you'll be there. 100% can be used on payroll. That's not a problem. So, really, it really became less and less of a problem with this 24-week period.
Yeah.
Anything else?
I was just going to add, I'm constantly being accused of belt and suspenders, but I'll just throw out there though, if you're accumulating these costs, tracking utilities, rent, mortgage interest is probably, that's a whole lot easier, honestly, for most of our clients than tracking payroll is. And so, if you're running it out, you might as well track it and throw it in. We have had a number of clients say, well, I'm just going to ignore my utilities. Why even bother adding that up? I'm going to have enough payroll. And our response is, look, you're going to file that forgiveness application. You want everything in there you can get.
Right. And the thing is that, we always kind of thought of it as, 60% and 40% as a hard number. And really it's the definition and the way the, the calculation works. It's grossing up your payroll amount 60, by 60%. So, it's taking that line one, what was your payroll amount, and dividing it by 60%. So it's not saying that you have to be 60-40 as far as, a hard number. And maybe, if your total costs are 110% of your loan, okay, like we said, the eligible expenses could be greater. Andrew, correct me if I'm wrong, but if you had a 60% payroll and 50% of others, because you're grossing it up, the minimum payroll, it's 60% of the actual loan and not 60% of your actual eligible expenses. And so you could have a mismatch of 60-50. It doesn't have to add up to 100% on the loan application. And so the 40 is really more irrelevant than it is the 60% being as a percentage of the loan amount, not of the total amount of what you spent in eligible expenses.
If you guys couldn't tell, Andrew is our in-house attorney, so he's very cautious about these things. So you listen to him. All right, moving on. Glenn, what if I reduce wages?
What if you reduce wages? Number 8. As you can see, this guy looks like he's in trouble. The reduction in wages, once again, has to be more than 25%. That's the key. So the 25%, and it's a strict number. If you were paying them $10 an hour, now you're paying them $7.40 an hour, then you've got a person that you have reduced more than 25%. Now the reduction in the actual amount that's forgiven is only the difference between the 25% and what you have. So if you're paying someone $7.40 an hour versus $10 an hour, you really only have a 10 cents per hour hit that you're going to take in your reduction. So you just kind of have to look at that and see where we are with that. If an employee was paid more than $100,000 a year, their reductions don't count. So, if you had somebody making $125,000 and you knocked them down to $90,000, well, that's more than 25%, but it's not going to count against you. Those people don't count. And then there's also the safe harbor. If wages are restored by the end of the covered period or the date forgiveness is filed, then you should be okay. And so if, you had to reduce wages for a while and now you've increased them back to where they were before, it's not a cumulative effect. It is, what are you doing right now? And so the object was to get people back above that 75% and restore their wages by the end of the covered period.
So Glenn, just a couple quick points here, because it's a couple things that I've gotten asked a number of times. First of all, keep in mind for your hourly people, it's a reduction in their hourly wage, not a reduction in the comp actually paid to the hourly person.
So not a reduction in hours.
Not a reduction in hours. That gets captured over on the FTE side. So it's actually, you would have actually had to take, and Glenn's example is a perfect one. You'd have had to actually take somebody who was getting paid $10 an hour and take them down to $7.49 or less in order to get hit with this. And the other thing is, it's for the employees making more than $100,000 a year, you didn't actually have to pay them more than $100,000 a year in 2019. You could not have paid them at a rate that exceeded $100,000 a year for any pay period. And that kicks a large number of people out. For example, we have clients who have, they pay a quarterly bonus to salespeople. And, maybe they've got a base comp of $1,500 a week or $1,000 a week or something, but then every quarter they get paid a bonus. And in that quarter, their comp, if you annualized it, would exceed $100,000 a year, and they're exempted from this calculation as well. So anyway, just wanted to.
Yes, I mean, basically, if you got, the $100,000 on a biweekly period, what's the number? It's about 1,900 something. Is that a week? I think. And then, so, if they got a $5,000 bonus at the end of the year, then that's a rate greater than $100,000. So one bonus from last year, even though they may have only made $80,000, that one bonus says, okay, you were paid at a rate of higher than 100,000. So that's a little bit of a technicality, in the way the law was written. So, you really have to, kind of look at that and make sure that you exclude those people, for those reasons.
We talk about a lot about that in webinar 3.
Just as we're transitioning, I got a question about a sole proprietor with no employees. Can you use the 24-week period? And the answer is no, because in effect, if you're a sole proprietor, your loan was based off of your income from last year, and it was essentially 2.5 months of your income. So if you had $100,000 for the whole year as a sole proprietor, your loan would have been $25,000. We're not even sure why a sole proprietor with no employees even has to file for forgiveness, because the maximum that you have, I mean, it's automatic. The $25,000 in my example would be automatic. I mean, it would be automatically forgiven because there is no employees. You're just a self-employed person. So you just kind of, you file the form and you move on.
Back to that rumor about the affidavit, that's probably one of the reasons that may happen. So
yeah.
Now we're moving over to Andrew, I believe, to talk about loan interest.
All right, so I asked a couple questions here. I think we can move through pretty quick, but this is one we've gotten a lot. People have asked, will I be forgiven for the interest on my PPP loan? So interest on your PPP loan begins accruing immediately. So the interest began accruing the date you were funded. But so long as your forgiveness application is filed within 10 months of the end of your covered period, your payments are deferred. So borrowers aren't having to make any payments so long as they file for forgiveness within 10 months. And then you've got the 60-day and 90-day periods. And as long as your loan is forgiven, the SBA pays the interest on the loan. So when the SBA makes their final decision about your forgiveness and remits the money back to your bank in order to pay the loan off, they'll also pay off any outstanding interest charges. If the SBA comes back and determines that all or some portion of the loan is not to be forgiven, then you will have accrued interest will be due, and the balance of whatever the unforgiven piece of the principal and accrued interest on that principal will be termed out either over a 2-year or 5-year period, depending on whether your loan was made prior to June 5th or after June 5th. And note that there is some flexibility for lenders to, to allow their borrowers the longer 5-year term period, but that has to be worked out on a case-by-case basis, I think.
So the next question is one that was given to us by our PPP team that has been working on applications, and they said that this is the #1 mistake that they're seeing. So we wanted to make sure to talk about it. That's why it's our number 10 here, that if you are doing this yourself, or even if you're sending us information, we want to make sure that you pay attention to Andrew talking about this now.
All right, thanks, Suzanne. So question number 10 is, what is the difference between my covered payroll period and my alternative covered payroll period? So without going down a rabbit hole of definitions, basically the guidance, the payroll protection program allows borrowers to select one of two covered periods with regards to payroll. One is a period that begins on the date your loan is funded, and it includes the date your loan is funded. So in other words, if you're counting your 8-week or 24-week period, you're counting it from the day you got your money and including the day you got your money. In the alternative, you can choose if you pay biweekly or more frequently. So if you pay every 2 weeks or every week, then you can choose an alternative. You can choose an alternative covered payroll period, and that payroll period begins on the first day of the first payroll cycle after your loan is funded. And that's where we probably see the most confusion, because a lot of people read that and they think, oh, it's the first payday after the date the loan was funded. And it's not the first payday after the loan was funded. It's the date your first pay cycle begins. So, in other words, if you have a pay cycle that runs from a Wednesday to Tuesday every week, and you pay on Friday, then it would start with that cycle that began the first Wednesday after your loan was funded. It wouldn't start on the Friday that you actually made the paychecks went out. And like I said, keep in mind that it's only available to those borrowers who are paying either biweekly or more frequently. So if you pay twice a month, you're not eligible for the alternative covered payroll period.
The other question similar to this one is, it's not an actual question, but it sort of goes with that one, is we're still getting, what exactly are our payroll costs? So Andrew, tell us a little bit about those.
Yeah, so payroll costs, this kind of walks through some of the things we know about payroll costs and some of the big questions. So they're considered paid on the date that the checks are actually distributed. You can have costs that are both paid and incurred. So in other words, you have, you can include the cost the dollars you actually pay during your covered period. And then if you've got, let's say your payroll period, your pay date is, let's say it's Friday, and your loan, your covered period ends on the following Thursday, so you're not going to pick up that next payroll. Well, you get to prorate that week of pay as long as the pay is paid on the next normal pay date. So you get to include costs both paid and incurred. That's continues to be a big question. And the payroll costs are pretty well defined in the IFRs in the rule, but essentially it includes all cash compensation. So normal salary, normal hourly wages, overtime, bonuses, all that sort of thing. That's all part of your payroll costs. So Suzanne or Glenn, anything you want to add there?
Nothing to add here. You, Glenn?
Nope.
All right, well, we all had a meme that represented us here in this slideshow, and I'm going to give you a second to think about who this one is. I will.
Not me.
We all know who this one is. Mine was the excited face at the beginning, and I'll let you look through the slides later to figure out which one was Glenn. So as of right now, there has not been any new guidance since June 25th. And so pretty much we've just been at the beach and, I've been doing my nails because there's really been nothing to read up on. Kidding, obviously. But still, there's a lot of things that remain unclear and unanswered. We talked about a few of them today during the webinar, but we don't know when the next guidance is coming out. That's a question we get a lot. When's the next guidance coming out? We don't know. It comes from SBA. We go to treasury.gov daily to check up on new things. We're obviously reading consistently new articles and everything that we can get our hands on to find out anything new to give you guys. But lately there hasn't been anything, and we will keep you posted. So we were just talking about a few items today that will probably drive our next webinar because we only have an hour, and this is a lot of good stuff. So we'll definitely have another one after this. So stay tuned for that. We have been going through a few of our questions. It looks like I've got a few minutes left here. So we have been getting them through Glenn and throughout the program, but we do have a couple common ones that came through with your registration. So if you registered and gave us a question, here is our first one. I believe, Andrew, you were going to take that one?
Sure. So how long do I have to keep people on payroll as part of the PPP forgiveness program? So essentially, you've got a couple tests here that are important. You've got your salary and wage reduction. You've got your FTE reduction, and that's what really goes to the heart of this. And like I said, that FTE reduction test, if you don't qualify for one of the safe harbors, you have to have those people on your payroll through the date, either the end of your covered period, which could be the end of the 24-week period, or the date you actually file for forgiveness. So that's the way that the application reads. It's either the end of the covered period or the date you file.
All right, our next one, Glenn, is there any specific guidance for government contractors?
Yeah, but first I need to answer a very important question from the chat.
Okay.
This is from John Endicott. He asked, did Glenn sell his bed for office furniture? And so, I have had a few questions about that in case you missed it at the very beginning. Yesterday we had a lightning strike very close to my house, and so I have no internet, phone, or TV, much to the chagrin of my teenage daughter, who is trying desperately any way she can to get one bar in our house. So I am currently at our Saltmarsh office, and that is why you do see something different. As far as government contractors go, it really depends, because you have to kind of look at what your contracts are and what your business is. You always have to make that certification that you needed the loan. So if you are a government contractor and all you have is a government contract, and you are continue to be paid under that contract during this period, so you are able to continue to pay all your employees, et cetera, then you may not even qualify for a loan because you couldn't certify that you were hurt or damaged from a business perspective with this pandemic. So that's number one. Number two is that if you do have other operations besides government contracts, you kind of have to look at what percentage that is. If you're paying things with PPP funds, then you may not be able to include them like in reimbursement rates and things like that, your G&A rates, expenses. So you kind of have to do some calculations based on excluding those costs from your overhead rates and whatnot. The other thing is that you're not going to be able to double dip in the sense that if you're on a cost reimbursement contract, you're not going to be able to double dip. So if you get PPP money and you pay employees, but then you can't turn around and bill the contract for those same employees that you paid with PPP money. So, that's the whole double dipping. So there are some specific things for government contractors that you just need to watch out for, then that it may affect other things. But certainly, if you qualify and you meet all this, the regulations and standards and all the things that we've been talking about, you should be fine.
Glenn, just to point something out, that double dipping also applies to a lot of our healthcare provider clients who, if you've got money from CARES or through the CARES Act through the Department of Health and Human Services, and you're wanting to use some payroll to justify that you've used that money properly, you're going to have to segregate your PPP funds and your CARES provider relief funds. So that's just something else to keep in mind.
All right, well, all of us have a favorite question that they've been getting, and mine is this one. So what expenses other than utilities can be forgiven? So this was a direct question from someone that registered. So payroll, obviously we've talked about, and then other than utilities, you've got rent and interest on real property loans. And so we did have a question, I believe. I'm not sure. Did we cover the line of credit one earlier? We get some, random questions about, can my line of credit interest count? That is not a real property loan, so that is excluded. The other thing we get a lot of questions on is fuel. And so the key here is everything must have a contract that was in effect prior to 2/15. So either a contract or a loan, it has to exist. It can't just be fuel that you're going to the gas station. It's speculative right now if you have fuel tanks and they're being filled on a regular basis. We're not sure. We haven't gotten final guidance on that. But the key thing here is that your contract or agreement or loan had to have been in effect at 2/15/20. So we are right, I believe, at 4. I'm going to pass it over to Jamie. I know she was having technical difficulties earlier, but hopefully she's still here and she can wrap us up. There you are.
Yes. All right. So thank you again for joining us this afternoon. As you guys know, these 3 are a wealth of information. We have a whole team that stands beside them and is helping in this process. So if you have any questions that we have not hit on today, if you're having trouble figuring out your own forgiveness, please reach out to us. You can see we've got a couple of different ways that we can help you, whether it's a full preparation and review or just being a sounding board and answering some questions for you. We're here. We're happy to help. And so please don't hesitate to reach out. That email that you can contact us at is ppp@saltmarshcpa.com. We've also got the direct email addresses for several of the folks on our team here for you as well. And if you haven't already, do check out our COVID Resource Hub. We have great information on all kinds of subjects, PPP included. If you have any questions, that would be a great place to check out. If you missed any of our previous webinars, I know they've been mentioned a lot today, and some of you have asked about how you can access those. If you go to this hub, you'll see webinar materials noted for any of our previously held webinars. You can get recordings and slide decks and other resources available there. So certainly check that out. If you can't find something, reach out to any of us and we'll point you in the right direction. So thank you again for your time and joining us, and we'll be in touch on our part 6, I guess. Stay tuned.
Thank you guys for joining. Have a great day.
Have a great day.